Hey, what's up, everyone? This is an ICT liquidity risk cheat sheet that I've made for you guys, and I'm super stoked on this, okay? You can double your win rate by recognizing high probability setups using leverage. So I want to talk about something I get asked about a lot, and A setups and B setups, and how I figure out which trades are like higher probability and which ones are lower probability. So basically, this is all based on ICT concepts and how I trade the US 30 and the NASDAQ. And I've learned a lot through experience that I want to share with you today. So here's the cool part. You can pretty much double your profits without even winning more trades. Sounds crazy? I know, but it works. It's all about knowing which setups are solid and cutting out the ones that aren't. That's where the real edge comes in. Okay, so now I know this is going to be a lot to take in all at once. In a future video, I'm going to make TradingView templates. Simple horizontal lines in TradingView, where all the info is already there. You just spot the liquidity and plug it into the template, and it will tell you the probability and the risk. So it makes life way easier in the morning when you're trying to do this. You're not trying to think, is it an A setup? Is it a B setup? It can all be lined up for you right in TradingView. What's an A setup? That's your highest probability trade, okay? Clean liquidity sweep, solid displacement, fair value gaps lining up, and the timing's right with institutional flow. Those are the trades I go all in on, full leverage. A B setup is more like a lower probability play. Maybe the sweep isn't perfect, there's some chop, or it's happening at a weaker time of the day. I'll take them sometimes, but at a reduced risk. And I know they're not as reliable as the A. Because, like, at the end of the day, have you ever wondered where the real liquidity lies? That is a matter of interest, okay? So the whole idea is to separate the really good textbook trades from the opportunistic ones so you can protect your capital, you can stay consistent, and actually make more profit without even trying to force more trades. All right, let's jump in, and I'll walk you through some examples here. So the first one, this is the A setups, high probability, except for news days I have here. And I've listed those news days in the B setups. So these are all full leverage. So number one, sweep of Asia extreme, high or low, no mid range. What that means is if it's sweeping Asia, it has to be an extreme, which is the extreme high or low external liquidity, not in the mid-range of a leg, like where it's trending down and the time just happens to be on a little mini high. It has to be the extreme high-low external. Sweep on previous days, highs or lows. Okay, so when you see this, it's definitely an A setup. Now, if you're trading on a Wednesday, and it sweeps Monday, so 2 days ago, that also counts as previous days, and that also is a high probability setup. Sweep of London high or low does not need to be an extreme or external. So this one is slightly different than the Asia sweep. This London high or low doesn't need to be an extreme or external. It could be anywhere. There's a lot of liquidity there, and it's a key area. Sweep of AM session high or low, not in the first AM macro, second or third, etc. What that means is basically if you're trading the first AM macro of New York and it sweeps the AM high or low in the first macro, it's not really the AM session high and low. That is just minor buy side, minor sell side at that point. Okay, but if it sweeps it in the second macro, I know that's still the AM, but that is still an A setup. Now the third macro, of course, is the beginning of lunch, so of course it's more pertinent there. The AM macro sweep is very high probability. So just not in the first AM macro. That's the only exception to the rule. Sweep of lunch highs, lows in the PM macro or previous days. So what that means is basically this can only happen in the PM macro, and you sweep the lunch high and low, and that can count as well if, say, it happens in the AM session and it sweeps the previous day's lunch high and lunch lows. Also a high probability setup. So it just means like the previous day, it's still a session, still a high probability liquidity rate at that point. So I said in the PM macro because it only could be in the PM macro, but it could be previous days. So the next one is sweep of PM session high and low. It does not apply to me unless previous days. Once again here, The reason why I'm saying it does not apply to me is because I don't trade past the third AM macro. If I do trade the PM session, I'm already in the PM session. So it can't sweep a session that you're already in. But if you're trading on a Wednesday and it sweeps out Tuesday's PM session, then in the AM session, right, then it is a high probability setup. It's an A setup because it happened in another session. This is huge. Clean displacement with a fair value gap present over a breaker or mitigation block. So what that means is the fair value gap, you need that displacement, and that's the institutional money injecting into the market, and that has to be paired with a breaker or mitigation block. You have to have that clean displacement. It has to be paired. So let's go into the B setups now and have a look. B setups lower the leverage in half on NFP, which is non-farm payroll, CPI, and FOMC. If you're going to trade those days, you're going to trade them on half leverage. Trust me, over 365 days, you're going to wish that you went half leverage. This makes a massive difference. So let's get right into the B setups. A sweep of Asia mid-range, not the extreme high and low. So it sweeps Asia just in the little mid-range where it's like on the middle of the leg, we'll call it. It's not an extreme high or low. It's a B setup. It's pretty straightforward. This one needs a little bit of explaining right here. A sweep of New York kill zone high or low. Now here I should have added in the AM session. So you have your first two morning macros, 1 and 2. If it sweeps the New York kill zone, high or low, that is a B setup. But what I failed to put here is that if it sweeps it in the PM or in the later part in the lunch, it becomes more of an A setup. I would kind of disregard that and focus more on if the New York kill zone is actually the extreme high or low of the day. If that time frame, the New York kill zone just happens to be the extreme high and low, then it is an A setup. Sweep of a minor buy side, sell side inside of the high time frame fair value gap, 15-minute time frame, and up to the daily. What that means is you have minor buy side, sell side that was created inside of a high time frame fair value gap. Now, this used to be an A setup for me, and I was kind of humming and hawing about this, but ICT himself teaches it. It's a B setup. Now, next one is any entry trading against an opposing 5-minute and 15-minute fair value gap. So what I mean by that is, let's say you're bearish and you want to go into a sell and there's a 5-minute bullish. When you're bearish, right there in your way, you're trading in it. You're trading on the edge, right, of the fair value gap. You need to go half risk, and I can't stress this enough. 5-minute and 15-minute opposing fair value gaps. This just lowers the probability in half. To be honest with you, make sure you try and match this up right here with an A setup liquidity with a high probable liquidity rate. Try to match this one up right here. Put that in your notes. Breaker block entries with no displacement or fair value gap. We want to pair this one right here with an A setup liquidity rate. What that means, it's closing over the breaker block, never the mitigation block, never the mitigation block. That's 2C plus, okay? So it closes over the breaker block, and that's your market structure shift technically, but there's no displacement at all or a fair value gap. You can take that at a B setup because they do work taking them off the breaker block, but you want to make sure, once again, this one right here, you're pairing it with an A setup, high probability liquidity rate. The last one here is any sweeps of liquidity inside the session itself. Oops, I spelled sweeps wrong. Sorry about that. So it sweeps the lunch inside of the lunch session. The only exception for that is the AM high and low inside of the second AM macro. As I have explained before, it can sweep the AM in the second macro, which is still the AM macro. So that being the only exception is the AM high and low inside of the second macro. So that's the breakdown of my A and B setups and how I use probability to filter out all the bad trades, and I focus on the ones that are actually going to move the needle. And that's how you get your accounts ahead without even having to increase your win rate. So if there's one thing you can take away from this video is that you don't need to increase your win rate to make more money. You just need to cut the lower probability trades and size them into the best ones. But you also don't want to miss out on trades, right? So over the next few videos, I'll be showing you how to simplify this even more with trading view templates. So instead of memorizing this checklist, you'll have everything already written out on your chart, right? You just identify the liquidity, apply the template that I'll show you, and instantly know where you're looking for an A setup or a B setup. So if you found this video helpful, please drop a comment and questions below and let me know which setups you struggle with the most. That way, I can make future videos breaking down those and in more detail as well. And of course, make sure you subscribe so you don't miss the next upload. Thanks for watching.